Hello, friends. Welcome to the Weekend Investing Daily Bite of 4th of February. And what a pleasant day it was. The weakness that we saw on Trump tariffs yesterday completely wiped out. In fact, we've crossed the budget day high, which is a very good sign from a market's perspective. I think all the recent weakness has been taken care of. Now, of course, it will depend upon whether we are going higher in terms of when we can come and make a higher low and a higher high going forward, or there's more time to go in terms of consolidation. That of course we don't know, but the situation on the tariff front has gotten diluted in the last 24 hours. There has been a 1 month postponement of the tariffs on Mexico and Canada, and China also is positioning itself to make some counter tariffs. So I think these are just sort of bluffing kind of positioning that is happening to make the other party, respond. Nothing more than that. Um, Today we'll talk about strength and weakness and how the weakness destroys your portfolio, how staying in strength protects your portfolio, and we'll take a look at a lot of data uh, and how our behavior towards this particular data actually impacts our investing going forward. Disclaimer to be read fully, and subscription to the channel is a must. If you haven't so far, please do so. This is the first time that we have been able to really cross the current moving average that we have on the chart since 2nd of January. So about a month has gone by and we are here. The last time it failed miserably. We really don't know how it will go from here, whether we'll consolidate more here or we will go and challenge 24,150. We have come very fast from 22 800 or 22,750 to 23,750. So 1,000 points have come in a jiffy. A lot of folks panicked and sold off here, and they are now completely in confusion whether they should buy back here or will there be more opportunity. That is always the case of confusion. So unless you follow a rule, you will always be finding yourself regretting about the situation. 1.6% on the Nifty, nobody is complaining. Very, very good number. 1.54% on Nifty Junior. This is also stabilizing right now. Let's see where we go. Mid caps 1.38%. So yesterday's gap is filled, but not yet above the budget day high. Still weak, I would say, versus large caps. Small caps not even taking out yesterday's high. So small caps being the weakest of the link amongst all these indices. Still 1.14% up. No complaints there either. Bank Nifty sort of looking like a great mover. We've basically broken out of this congestion zone of 49,600 to 48,000 and are now looking upwards. And we've crossed the 50,000 mark. Also, this breakdown point that was there from mid November also has been taken out today. So 1.9% on the Bank Nifty. Gold up 0.8%. So a lot of folks were talking about gold will crash now because tariffs have been taken back, but nothing of that sort is happening. Indian gold is above 83,000 now, plus GST and all those things. So the landed cost is going to be even much higher. Just see the way it has taken off in the last month or two. Just amazing how this asset class is rising. Momentum trends. 356 advances to 145 declines. So the bias is in favor of the advances today. Almost, you can say this is the most green screen that you would have seen in a long time. Reliance up 3%, HDFC Bank 2.5%, State Bank of India 2.5%, Kotak Bank, Axis Bank 2.5%, Ultrasemco 3%, Tata Motors, which is the probably one of the weakest stocks right now, also up 3.3%. And you had Asian Paints, L&T 4.5%. Amazing kind of run today. And these kind of moves usually are signaling some sort of change in the market. This is not a flash in the pan kind of a move, as far as I can understand this. Uh, Remarkable comeback on some capital goods businesses. ABB up 8.3%, Siemens 3.7, BHEL 5.3, and even Public sector enterprise stocks, which were drubbed yesterday, have been very very strong today. HAL 5.7%, REC 5% each. I mean, this is a fantastic comeback. Some of the stocks that were running yesterday have cooled off. DB's Lab, IOC, LTIM also up. DLF up 1.8%. Overall, a good move, very broad-based move. And you can see why all sectors except consumption and FMCG, these were down a bit. Otherwise, all sectors up. Public sector enterprise stocks leading, oil and gas, capital markets, PSU banks, infra, defense, energy, private banks, financial services, CPSCs, all up more than 2% today. In the last 1 week, there is nothing now which is in the red. Real estate has run up 10.7% in the last 1 week. Tourism stocks 6.8%, consumption stocks 6.1%. These have been the leading sectors. Of course, in the last 1 month, we still don't have much green, any green, in fact. So that picture can change if this trend would continue. But for now, it's a good day. Public sector enterprise stocks uh, gaining 2.7%, and these were all the stocks that gained: HAL, REC, BHEL, Power Finance, SAIL, Bharat Electronics, and so on and so forth. Now let's come to the main story of the day. Don't let weakness destroy your portfolio. So let me just give you some background to this thesis here. Is that when you see the market from a value perspective, you want to buy it at the lowest value, right? I mean, that's what we have always been, that's drilled into our heads: buy low, sell high. Buy into weakness, sell into strength. Buy when everybody's bleeding, sell when everybody's greedy. All these are very nice to hear, but very difficult to implement. Because, I mean, how much blood do you want to see before you want to invest? Try to quantify that. How much greed do you want to see before you sell your things? Try to quantify that. We had blood 7 days back. How much was it? I don't know. Was it enough for you to put in a significant amount, or was it not telling you that story? So again, this is a very very subjective way of looking at things. A more objective way is obviously a quantified way, where data is used to determine what is a trend upwards, what is a trend downwards, what's going up, what's coming down, so on and so forth, so that you are more reliant on the data rather than your sort of thought process that maybe this is the bottom, maybe this is the top, and so on and so forth. Also, the human psychology towards investing is such that as soon as the stock starts to go up, people start to become afraid that it will fall down. My thesis is that if a stock is falling down, you should be very afraid, because you're losing money. If the stock is going in your favor, you should not be afraid. You should, in fact, be very happy that you bought a stock and it is going the way you wanted it to go. Right. So this entire behavior thing is what causes 98% people to not perform to their best of abilities, because on one hand, one side of your brain is telling you, stock is going up, sell it, book profits. On the other hand, while going down, it is telling you stock is down, buy, it will go up later on. On the flip side, the thesis is that if a stock is going up, it is gathering momentum, it is in a trend, it is likely to travel on that path for at least some more time. Sometimes it is 1 month, sometimes it is 6 months, sometimes it is 5 years. You don't know, right? So you don't want to jump off a running train. If you've been able to be lucky enough to board a train that is running, why would you want to give up your position on that? And if you are on board a train which you can feel that it is braking, and the train is going to stop sometime soon, and rather it's going to go back, you have to jump off, right? I mean, that's a disaster waiting to happen. So it is all about how you see the markets, how you see stocks, and the sooner you can you know imbibe these things that I'm talking about, strengths and weaknesses, you will find a big difference in your portfolio and investing that will come to you. So, what we will discuss today are all the NSE benchmark indices. How much have they dropped from the 52-week highs? What is the strength and weakness within them? Basis the 52-week high mark. So it's a lot of data crunching that we'll do. Uh, we will also gain perspective on market strength and weakness, and to align with strength and discard weakness quickly is the way to maximize your opportunity and the potential of your capital. So if we look at benchmark indices from as of 4th of February, and this study was done at 11 a.m. this morning, you can see that 18.8% is the drop in Nifty Junior. So Nifty Junior has dropped the most, which is very surprising. Nifty Junior is basically, you know, dropping less than small caps, less than micro caps, less than mid caps is extremely, abnormal, I would say. And then you have CNX 500, which has dropped 12%. Nifty has dropped 10.4%. Bank Nifty has dropped 8.5. This is the hierarchy of the drops. You can see micro caps have dropped less than small caps. It doesn't make sense, but that's what has happened. Mid caps are sort of in line with CNX 500, which is slightly worse off than Nifty. So that's where we are in terms of the benchmark indices. Now, uh, in terms of 52-week drop range, now below 50%, how many stocks are there which are below 50%? So Nifty has no stock which is below 50%. Nifty next 50 has only 2%. Mid caps also 2%. So across the board, there are very few stocks which have dropped more than 50%. So that, at least in the top, like top 500 stocks, you can say. Then the major chunk that you can see is between 20 and 40%, where mid caps have almost 66% in this range. You have 61% in small caps here, 50% in Bank Nifty. You have 60% in Nifty Next 50, and 40% of the stocks are in 20 to 40% range. 10 to 20% also is higher in larger caps than in mid and small caps. That is a bit of a surprise also here. And of course, a minimal fall of 0 to 10% uh, is there in Nifty 50. 27% stocks are only less than 10% down. So Nifty, some stocks have done really well, have dropped less than 10%. In Nifty Next 50, that number is only 6%, mid caps is only 11%, small caps only 5%. Bank Nifty also has not done so badly, where 50% of the stocks are within the top 20% falls. So you can see that despite so much FII selling, you still have significant number of stocks in Nifty and Bank Nifty which are still within the top 20% from their maximum ranges. So if we look at Nifty, for instance, we'll also look at some charts. Nifty is down 10.4% now after this run up, of course, from 52-week high, and we are getting closer to the 200 DMA and to the 50 DMA. So if we were to close above 24,000, that will be a very big win for Nifty going forward. We are about 300 points away from that point. Within the Nifty 50, you have Tata Motors, Adani Enterprise, IndusInd Bank, Asian Paints, and BPCL. These are the biggest losers within the Nifty. Uh, these stocks ideally should not have been in your portfolio in the recent months. If you had checked out weakness from Nifty stocks. And what should have been in your portfolio should have been Wipro, Kotak Bank, Eicher Motors, Mahindra, Bajaj Finance. Not all of them, perhaps, but maybe some of them, and they have been the least sort of hit, or at least now your portfolio should look like this more than this. That should be the whole idea, that you are staying with the relative strength in the index versus the absolute weakness in the index. Nifty Next 50 is sort of the worst index right now. It's dropped 18% from 52-week high right now. It's reasonably far from its 200-day moving average, almost 10% there. So this is probably most oversold. But here also you have Divi's Labs, Shree Cements, TVS Motors, Bajaj Holding, and United Spirits, which are in the top 50 stocks, dropping the least. Whereas Adani Green, Adani Total, Adani Ensol, Adani Power, JSW Energy, these have dropped the most. So these should have exited your portfolio, and some of these new ones should have come into your portfolio. Within the mid cap 150 space, which is down 12% from the top as of now, here also you can see the death cross is happening. 2775 is the 200 DMA on this here. MRPL, Kochi Ship, Idea, Oil, and SKF India. These have been the worst performers. There were some of these stocks which were doing really well a year back, but now they have dropped to the lowest levels. SRF, United Phosphorus, Muthoot Finance, SBI, and JK Cement, these have been least hit from a 52-week perspective, and these are probably the safer bets right now than the bottom five. In the small cap 250 space, this is down 15.8% from 52-week high. Here you have the bottom at Spark, 66% down already. SW Solar 61%, Chennai Petro 59, Honasa 58, Network 57%. Big drops in these stocks. As these stocks were coming down, these stocks should have been exited. And Laurus Labs, Karur Vysya, Naveen Fluorine, City Union Bank, and Narayan Rajale, these are the least hit in terms of the last 52-week high numbers. These probably should gradually find space in your portfolio as you go forward. And if you look at Bank Nifty is down 15.8% from a 52-week low perspective. These are the worst elements of Bank Nifty right now. IndusInd Bank 35%, PNB 30%, Bank of Baroda 29%, Canara Bank, IDFC all down big numbers. And you have Kotak Bank, which is down only 2.4% now, ICICI 6%, HDFC 10%, State Bank 15, and Federal 15. So even the best of the top five have some reasonable weakness here. But when you have a very, I think there are 12 stocks in Bank Nifty, so you can only get so many good ones from there. So in tomorrow's daily bite we will cover stocks and insights from these sectors, how much each sector has dropped and what has been the the inside information of each of these sectors. All sectors are down, no doubt about it, but some are down less than others, and within each sector you will find that there are stocks that may be performing. So that is reserved for tomorrow. uh, the idea here is to gradually make you appreciate the role of strength in a portfolio. And a very simple example of that, an analogy if you may consider, is that let's say you are walking on the road and you fall into a ditch, and that ditch is only, let's say, 3 feet deep. So you will get out and start to walk again. Maybe you are scratched, but you'll walk again. But if that ditch is not 3 feet deep, it is 30 feet deep. It is very difficult to come out of that. So as you allow your stocks to go to 60, 70, 80, 90% drawdowns, you need a 5 bagger, 10 bagger from there to come out of that ditch. But if you allow your stocks only 10, 20% and you get out of them, you move to other stocks which are moving, you are pretty much unhurt in your journey along. So just rethink, listen to this part of the analogy and see what makes sense to you. Uh, it will absolutely not make any style of investing you may be doing. It will absolutely not make sense to be in that deep red zone from where you are having difficulty to come out. And hence, booking small losses is always better than waiting out with a deep loss, because that may never recover. Thank you so much for watching. Do like and share this video if you liked it, and do subscribe to the channel. Thank you.